how do you actually deal with this complexity? Let's talk about it in terms of investment talent, investment team, and processes, and see what we can learn from that. If we start with investment talent, let's just look at some gentlemen and ladies. This industry needs a little bit of diversity, so don't be shy. But here are some of the world's best investors. David Swensen from the Yale Management Company, Julian Robertson from Tiger Funds. He's a pioneer in the hedge fund world. Billy Graham, which is Warren Buffett's mentor, in fact. Soros and Ray Dalio from Bridgewater. I've had the opportunity and privilege, actually, of meeting several of these people and discussing with them. And what's striking is that you think these people are totally full of themselves, they're masters of the universe, they control the room. These guys are very humble, very thoughtful, and very curious people. They're not finished. They just keep on learning, they keep on seeking out new knowledge, tweaking their model all the time. Now let's just look at Julian for a second. His model is he's extremely good at picking investment talent. And you can't read the slide, but what the slide is, and then he brings them in-house, and they're so successful that he just outsources them. He gives them money, and he lets them start their own hedge funds. And so he's the Tiger Daddy. Tiger is the, and the rest of the list here are the Tiger Cubs. And all of these 34 Tiger Cubs are exceptionally successful hedge funds. Now, I had an opportunity to meet with him last year, and he always goes around with his psychiatrist, Aaron Stern, who's about 80, 85 years old, a fascinating guy. But those two together, they do all the recruiting. And this guy's a psychoanalyst, but a very wise one. So, finding the right talent and dealing with them in the right way is key. Now, we don't need to spend much time on that, but the point being, humbleness and, what is he looking for in people? Smart, honest. You don't think about hedge fund managers very honest, but that's important here. And close behind that is competitiveness. Someone who won't lose doesn't lose. Ray Dalio, in this quote, and that says something that typifies all of these investors, and that is, they constantly question their own decisions. And not like, I know best. They constantly question their own decision. They recognize that they make mistakes, and I'll talk more about that later. That comes with the business. And they use those mistakes to improve their processes, improve their thinking, and do something different the next time around. Now, let's talk a little bit about team. Yale has been a long-time investor in our fund. They have a fantastic team of 25 people that are really good at picking investment managers, obviously, since they picked us. Now, the whole thing about the Yale model is that if you look at endowments of the last 20 years or so, you see that endowments, U.S. endowments, made about 8.5% annual return. If you just took Yale's asset mix, because they have more private equity, more venture capital, more forestry investment than the average, you would get, 9.6%. So what makes up for the difference, the 4% up to their actual performance? That is actually manager selection. They are very good. This team is extremely good at picking the best private equity venture capital firms that consistently produce time. Now, Let's turn to something else. I've been on to the point of not going with the herd, investing contrarian. Now, it sounds like a good idea, but it's actually very, very difficult, and it requires a lot of discipline. Because if you are in an organization where you're doing something different than the market, and that will eventually, go wrong for periods of time, it is very hard to actually stay on the track you pointed out, or protect your career. So if the managers or the leaders in an investment organization is not aware of that danger, you are not going to get contrarian behavior. So you have this dilemma that most institutional investors will kind of drift back into what the market is doing for that reason. Now let me give you an example which makes this vivid for you. This is the Morgan Stanley Composite Index, World Index from 2000 to today. The Norwegian Sovereign Wealth Fund is a $1 trillion fund. It's the largest sovereign wealth fund in the world. It has actually managed to beat the index, which is amazing given the size of that fund. Now, how have they done that? Well, they've done that by institutionalizing contrarian behavior. And what is that? They basically, one very simple rule, and that is that at any one point in time, you're going to have 40% fixed income and 60% equities in a portfolio. So if you're going to have that and the market starts falling like it did from 2000 to 2003, what do? Well, you have to buy equities to keep it at 60%. And when the market rises again, you have to sell equities. Now you're doing exactly what you should be doing. You're buying into a low market and you're selling off a high market. Now, what's the problem with this? You remember my partner and chairman, I was on Kofi Annan's working group. The reason he was on Kofi Annan's working group was that he was the founding CEO of the Norwegian Sovereign Wealth Fund. So he built the fund to about $750 billion. He's pictured on the picture here. And what the caption here says, for those of you who don't read Norwegian, putting everything in equities after having lost $40 billion in the third quarter. Now, what's the poor guy do? And the owners of this fund, the owners of the risk here is the parliament. What do people, members of parliament, say when they see that headline? Is he crazy? And trust me, there was a lot of pressure. Now let's fast forward to his successor. Same thing, global financial crisis. What happens? Shares plummet. The numbers, the red numbers, are just mind-boggling. In 2009, late 2008, 2009, the Norwegian Sovereign Wealth Fund was the biggest single buyer of equities in the world. They were following the rules, 60% buying. And guess what? They lost 40, the index went down by 40%, and then it popped back up again by 40%. So now he's smelling like a rose. Now, let's look at another institution, which did things a little bit different. Do you know CalPERS, California State Public Employees Retirement Fund? They panicked. What happened? First, they invested. They went from a 5% allocation to real estate in 2003 to 9% allocation of real estate in 2007. How smart was that? That was just, buying into the bubble right before it burst. So that cost them a fair amount of money. But it got worse because when the market crashed, they panicked. And their allocation to equities at the Norwegian, I sound very arrogant now since I'm Norwegian, but they actually did this very well. Their allocation to equities with the Norwegian sovereign wealth fund stayed at 60% right through the whole turbulence. They went from 60 to 52% in 2008 to 44% in 2009. And they never recovered. They lost $70 billion, and it's a $250 billion pension fund. That's a lot of money. That's a lot of people that have to work longer. Now, and that is, give you an example. They sold out 2.3 million shares in Apple for $320 million in 2009. In 2011, those 2.3 million shares were worth $980 million. So when you get into that and you lose discipline and you don't follow the rule because you got all these pressures on you, things can go really, really wrong. Get the culture right. You got to be a learning organization. You got to be a tolerant organization. It's got to be okay to make mistakes. It's not okay not to dissect those mistakes and learn from them. But you got to be competitive. You got to be strive for excellence. You got to avoid groupthink, etc. This is what we try to build into our firm as well. Now, if I just take some extracts out of our values, we talk about meritocracy, recruiting and developing and empowering the best people, talent, attraction, teamwork and collaboration. We nurture a winning culture. We're very competitive. We want to be best. We have an uncompromising determination to achieve excellence. We're managing a lot of money. We always face the brutal facts. It's very important when you're making investment decisions and you're running companies. There's a horrible tendency to go into denial. Face the brutal facts, address it, and get it over with. We pride ourselves on our ability to avoid groupthink, and we promote a process of intellectual dissent. We encourage that, all the way down to the most junior people. Stand up if you have a question. If you don't like something, ask the question. Doesn't matter if it's Frode who's saying it or it's the chairman saying it. Ask the question, and disagree, but be respectful. Always be respectful. Always be factual. So you're entitled to your own opinion, but not your own facts. We thrive on positive dissatisfaction, meaning dissatisfaction with status quo. So we always try to learn. We call ourselves a learning organization to get better. And we recognize that we do make mistakes. But as Ray Dalio said, it's not tolerable to make mistakes and not learn from them, to get better. So the way we develop our organization is every 6 months we have performance reviews, and the people are being reviewed on 2 dimensions. One is, are you actually creating results for our investors? And are you reinforcing our values? And if you want to be promoted, you need to be in the top right-hand corner. In an investment firm, in a big asset management firm, you need to empower teams, okay? In our firm, we basically make 4 or 5 investments per year. There's got to be an element of command and control. But more importantly, it's very important to bring together all the wisdom of all the partners, and in fact, the entire organization. So every investment that we make, we have 10 executive advisors, which are leading Nordic CEOs that we bring in to use the advice. We bring them into the process. We bring all the professionals into the process, and we hear everybody out. Then the partners retire with the investment committee, to a separate room and we make the decision. So then we get as much input as we can. So that's basically how we run our process. Kathy, you asked earlier today, how do you find investments? We don't sit around and wait for the bankers to kind of send us teasers. Those deals are generally today overbanked and you have to pay a full multiple. So we have one very important KPI, and that is 1 meeting a day. Get out from behind your desk and go out and meet a new company every day. And it needs to be a company within an EBITDA of, say, $10 million to $50 million. So the question is, what could possibly go wrong? And that's when we bring in the X factor. And that's called investment acumen. What is that? Well, a lot of stuff goes into that. Now you're dealing with the softer factors. You're dealing with the gut factor. You're dealing with the appetite for risk factor. Are you actually able to take it? Sensing, instinct, reflexes, integrity versus exuberance. We talked about the psychology in the room and what happens when you're very successful. Well, you tend to get a little exuberant, and that's very, very dangerous. You've got to have conviction. We stop processes very quickly if we see that what we call a deal team, the 3 or 4 people that are working on a particular deal, don't have deal conviction. So you've got to have people that are driving, I really want to do this. I want to do it, driving it through. But then we use a second pair of eyes, which is a senior partner that always looks over their shoulder and balances that out through the process before you bring it into the investment committee. Contrarian, we talked about luck. Is that a great investor? Do they just happen to be lucky? Well, I'll talk about that in a second as well. And then the brutal facts. Can you face up to them? Now, let's start out by talking a little bit about luck. Any of you remember Ingmar Stenmark? He won 70 World Cup races back in the 70s and 80s. The only thing I know about luck is the more I train, the luckier I get. And, that's very true. You got to work to get luck. But there's one more thing about luck, and a very important thing, which differentiates both good investors, good leaders, from other people, and that is the concept of return on luck. What do you do when you get good luck? Are you exploiting it to your advantage? And what happens when you're confronted with bad luck? How are you dealing with that? Are you managed to work around it? So to give you an example, you saw the multiples I showed you. We have to invest money. We only have 5 years to invest it. The multiples in the market are 11.5. We have to put in 6 times earnings in equity. So we're really unlucky, right? Right now, we're quite unlucky. Now, really? Can we work around that one? Yeah, you can if you source private deals and off-market deals, and we have 1 meeting a day and you do all of this stuff. You can actually buy companies significantly below that. We bought 5 companies last year. We bought them at an average of 8.2, not 11.5, because we managed to get into these private partnerships. Now, what's the flip side of buying into a very high market? We also have to sell our companies. So on that side, we're really lucky. Really lucky. Pricing is sky high. Great time to sell businesses. So what we also did last year is we sold and IPO'd 6 of our companies at an average multiple of 11.4. So, it's how you deal with this. So that's obviously a big multiple arbitrage. We're buying in at a sensible level, and we're selling out at a high level. Now, what can you learn from your mistakes? I missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to take the game-winning shot and missed. I've failed over and over and over again in my life, and that's why I succeed. There's a lot of truth in that. You go through life and you think when you're a young student, you think you're not going to make any mistakes. You make mistakes all the time. The point is, what can you take away from those mistakes? And that's particularly important when you're making investments, because I guarantee you will make mistakes. So wrap it up. So what we do, private equity is entrepreneurial. You must accept and crave the unknown. It's dynamic. Deals, portfolio companies, markets are alive, no constants. Surrender to the fact that you have to deal with uncertainty, and that goes for all investments. Analysis has a utility curve. Analysis paralysis is quite common. People that just cannot let go of the calculator or the model and make a decision. And it's risky, but risk is good. Without risk, there is no return. So you got to take risk. Surrender yourself to the fact that sooner or later, you will make a mistake. It should not be from bad processes. It should not be from loss of focus. It should not be from analysis. It should not be from governance, poor governance. But you will make the wrong judgment call, and just live with that. Investor instinct, I think, can be developed, as can good reflexes, but it takes discipline, focus, and an open mind to do that, being a learning individual. And as a learning individual, remember, the definition of insanity is doing the same thing over and over again and expecting a different outcome.